Well, I really hope you have been enjoying our Profitable Property Secrets Week, which is co-hosted with Steve Bolton, HMO landlord and founder of Platinum Property Partners. And we've been talking about some of the mistakes that Steve himself made and learned from and has documented in his book of the same title of this week. And we will be putting some links below the videos of how you can get a copy of the book as well if you want to dive a bit deeper into these topics. And Steve, today we've reached the topic of leverage.
Yep.
And you regard it as a serious mistake for landlords not to take advantage of this. And it's interesting because one of the very common questions on Property Tribes is, should I just buy for cash or should I buy using buy-to-let mortgages? And you have very, very definite view on this, don't you?
Very clear view, yeah. And there isn't one answer for everybody. So I think if you're in the very fortunate position where you've got shed loads of money and you want to buy property and you don't need to take mortgages, then do that.
Happy days.
Yeah, don't get mortgages if you don't need them. The challenge for most people is a property portfolio is expensive, hundreds of thousands, millions of pounds, and therefore the only way for some people to achieve a financial objective, whether that's buying a house or a flat to live in, how many people that are not gifted money, and even if they are gifted some money, still have to get a mortgage, right, for their first flat or their first house that they live in. So we all kind of understand the concept of mortgages, and I look at leverage like a magnifying glass, and it can either magnify the positive if you get things right, or it, as we saw in the global financial crisis, it can magnify the negative, right? So it's a very dangerous thing if used in the wrong way. And so people talk quite often about good debt and bad debt. And so good debt is where you don't take on too much debt, but the asset will generate more income than the cost of the debt, right? With a good margin there as well, because tenants don't pay rent sometimes, interest rates can go up, property market can correct, go down a bit. So factor the downside in, always, I always sort of think, what's the worst that can happen? Having had to sell my home to not go bankrupt, that's like quite a personal scarring experience to say, right, I should have considered more about the downside. Because it's always easy to be optimistic. So stress test things, look at the downside, don't over leverage too much. So the days of 125% Northern Rock mortgages pre-financial crisis, or 95% GMAT mortgages that then got securitized and sold on after 3 months, and they didn't do any diligence, they didn't care, right? You had an American-based mortgage lender that would pretty much give anybody with a pulse a mortgage. They would only audit 1 in 10 that came through. So 9 out of 10 people could pretty much write whatever they wanted on the form, wouldn't get checked. 3 months later, they packaged that up and sold it to somebody else, Deutsche Bank and people like that then bought them. And that's what fundamentally caused the big cause of the financial crisis. So those days are gone. It's now 70%, 75, 80, 85% for sort of buy-to-let kind of lending. So the key thing is make sure you have more than enough income after factoring in all the risks and the things that can go wrong to still service the mortgage at the level that you're going to get it up to. If you're concerned about interest rate risk, take out a 3-year fixed mortgage or a 5-year fixed rate mortgage, which is actually a good indicator of what the money markets think is going to happen with interest rates in the future. When you start seeing 5-year interest rates tick up, then actually generally the sentiment in the money markets is, but we're in compared to history, the first property that I bought in 1992, was 6.5% interest. Well, we're about half of that now, even less on single occupancy. So stress test things realistically. Then look at what impact would that have if those things go wrong on your ability to service the mortgage payments. The second part of it, actually it's the first part, can you get a mortgage in the first place? Right? It's kind of fundamentally important. It's based on 3-4 times income for your own homes or holiday homes. It's based on usually, check with you, I'm not a mortgage broker, so take the right advice, but the general rule is £25,000 worth of either salaried or declarable kind of income from certain sources as a minimum, and then the buy-to-let ratio, the affordability criteria of how much rent are you going to generate, what's the lender's criteria of how much they'll lend against that affordability test. So before you even start looking at buying houses, I always say go and see your mortgage brokers and find out what mortgages can I get, to what value, at what interest rate, so you've got that sort of clarity before you start thinking about it. But if you don't need mortgages, don't take them.
I think as you said, leverage is a double-edged sword. But for those people that are looking to scale up, it's a very, very amazing tool. And if you can get into 4 properties instead of 1, you're obviously going to benefit from 4 lots of capital growth, hopefully, instead of just 1. So it's a wonderful tool, and but as you say, it has to be used with discretion. And people that do over leverage or even go into negative equity, they are in potentially a very dangerous situation. So I think understanding leverage is very important.
Yeah, and I think a lot, the people I've seen make the biggest mistakes are people that are ignorant. It's too easy, they leverage too high, they don't factor in the downsides. I mean, I always describe debt as like a pyramid, or the strategy to do with debt. If you need to get mortgages to scale your income and build a bigger portfolio, see it like a pyramid. I had a guy actually that I met earlier today. He's an experienced franchise partner with 4 houses in the sort of Cambridge area. And I remember he reminded me this morning, he said, look, when I first came to a PPP Discovery Day and I was talking to you guys about it, I came away and I'd done my model. I wanted 15 houses. And I sort of said, okay, the upside of 15 houses is really nice level of income, over 200 grand a year income if you got to 15 houses, really nice portfolio that if it grows over time will be fantastic. So that's the upside.
Yeah.
The downside is, have you worked out how much debt that would be? How do you feel about being in £4 million worth of debt, or £5 million? Even if you've got equity in the portfolio, is that a burden that you want? And actually, he's scaled back his portfolio now to 6. His aspirations were 6. He's on number 4, and he's going toward. He wants to do 6, not 15. He just reminded me this morning. And so, what I sort of say to people is see debt as a kind of pyramid. You use debt. Going up the pyramid, you're taking on more debt to get to a certain level. But actually, when you get to the level that you want, either in terms of income or what you're comfortable with, okay, then you start paying down the debt. Yeah, and that might be the surplus income. If you've got interest-only mortgages, you might switch a lot of them to repayment. So actually start paying down the mortgage. You might get a slightly bigger portfolio than you need, hold it for 5, 10, 20 years, sell off half the portfolio, pay off all the mortgages. There's tax implications in this as well. But philosophically, I am not saying take on loads of debt. Debt's amazing, debt's great. No, it's a magnifying glass. You can scale up the positive, and as I did, help me build a portfolio of 20 HMOs, and we still use mortgages to buy hotels and that sort of thing, but you get to a level, then actually you start paying down the debt. And take tax advice and that sort of thing. So yes, it's super good if you need it, but don't over leverage. Be mindful and have a plan to reduce it.
I think certainly in the kind of era where there was a lot of house price appreciation, a lot of people used the model to wait for property prices to go up, then refinance and go to a higher loan to value, and then take that money to buy more property. And I think a lot of those people probably are going to find themselves in trouble in the current market conditions. But I know one thing that you're a big fan of is actually forcing the appreciation through improvements and development and refurbishment, because that's something you've really got control over.
You have and you haven't. So to a degree, what you spend, absolutely. So what do you have control over? You have control over the price you buy the house at in the first place. So trying to get the best price. But as we said on one of the previous episodes, it's not always the case. But how much you spend on it, so spending as little as you can, but getting a high quality product. So benchmarking what it costs. But importantly, what you can't control is what a surveyor or a buyer is going to offer you. Yeah, because ultimately what's something worth, it's worth what somebody's willing to sell it for and what somebody's willing to buy it for, or what somebody, in the case of remortgaging, what somebody's willing to survey it or revalue it at. And I think in this market, do not be bullish about refinance valuations, okay, because it's uncertain, so actually I would always say err on the side of caution. Don't think I'm going to spend 10 grand, 100 grand on improving it and it's going to be worth 100, 10 or 100, or, you know, almost discount it to say I'm going to spend 100, it's only going to be worth 80 more than I've spent on it. Take those conservative assumptions, then you'll be pleasantly surprised, as opposed to, oh, my strategy is now fundamentally flawed.
I think it's interesting with the introduction of the PRA that anyway loan to values have decreased over the last 4 or 5 years, and I think typically now I always say to people on Property Tribes, I don't know what you think, but I think typically to be at 60-65% loan to value is a comfortable place to be, relatively low risk.
Yeah, I mean, I think that would come, I would agree, the lower the better, but needs must. And there are certain circumstances where, you know, some flats across the way that actually I wouldn't want more than 25% loan to value because the yield is so low, you know, so it very much kind of horses for courses. So, yeah, I think the lower the better, but the reality is to get the income and a portfolio most people need, then sometimes you have to go up to sort of 75%, 80%. But if you've got the right strategy in the right area and good income, that's the key thing, because always assume that whatever you buy is going to be worth at some point 15 to 20% less. You know, and I always say assume zero capital growth. Does your strategy still stack up with zero capital growth?
Yeah.
You know, PPPs does. It's built on that 20 grand per property per year extra income. If it goes down, nobody's jumping up with joy, but we're still making 20 grand a year, right? So after all of your costs, that's a really nice, safe place to be.
It is, and also it helps you to remain in the game longer in order to benefit from capital growth if it does occur in the future. So, well, that's fantastic, Steve. And do look at our previous video about numbers and metrics as well, because it's relevant to this conversation as well, isn't it? So tomorrow we are going to be going into part 5 of our video mini series, and I'll be talking to Steve about some mistakes of choosing the wrong investment in the wrong location. I know I've done that myself. I learnt the hard way, and funny enough, it was one of those ones where my gut instinct said it was wrong, but I just had blinkers on and I thought, no, I'm going to do this. So do join us again as our Profitable Property Secrets Week continues.